Hello, folks. Welcome to Pro Trader Strategies Market Commentary for Wednesday, September the 8th. I'm Eric Wilkinson, and we are an educational company. So if you want to learn more about the options and how to trade those around the markets, hit that subscribe button. Also, I'm not always coming on announced. So right next to it, there's a little bell that you can click on that will give you a notification when I come on unannounced. We're usually doing these daily market commentaries or these spot the trade early morning videos around trades that I find. But if I find something a little bit earlier, I might pop on a little bit earlier, and that way you will know. Also, I might come on a little bit later on in the afternoon and talk about trades that I find in the afternoon. So please make sure you guys have that bell notification clicked. Throughout this video, comment over at the side. You want me to look at a specific stock, ETF, future? Throw it over there. We'll look at it, make sure that we are all on the same page on anything there. All right. So please make sure you're commenting over at the side. And also, we're going to be starting to do some interviews. Throw over there in the comment section on people that you want me to try and seek out to try and get on the show to talk about the markets. All right. So finally, smash the like button. It's like feeding those little bots. It's going to run out there in the Twitter or in the internet and try and find somebody that looks just like you. So throw those things a little JPEG, I guess, if you're smashing that like button. All right, without further ado, let's get on with the economic data. Not really a whole lot going on, but something that we're going to be talking about, these levers and pulleys. Just last Friday, first Friday of the month, we saw the unemployment numbers. We were expecting somewhere in the vicinity of 800,000 hires. We only got 250,000 hires. People are not getting jobs. Now we're getting today the JOLTS job openings. That number continues to increase, folks. That means there are jobs out there waiting to be filled. And last month, if you guys remember, it was right around 10. Now it's 11 million job openings. That just doesn't really compute, folks. We're talking about seeing its inflation go higher and unemployment not really budging here. Those types of situations are going to be very difficult for the Fed to maneuver around. They cannot raise interest rates if we are not getting this employment, and they're going to be stuck in a corner with rising inflation, which is a mandate to raise interest rates, but then they can't do that because we're not getting employment to follow it. So that is probably the most difficult situation for the Fed to be in, all right, is when you have rising interest rates and low employment. That is a very bad combination. And we also got the tip economic optimism. Anything above 50 is expansion. Anything below 50 is contraction. And we got a 48.5. That is contraction, folks. It was supposed to be a 55, right around what we saw last month. All right. So we're seeing these numbers precipitously drop throughout the summertime here, and that's not a good thing heading into the holiday season. So economic optimism is way off there. And keep in mind, we also later on this afternoon have that beige book. Now, the beige book is going to be a huge indicator for the FOMC. That's one of the things that they look at for the economic indicators. It's the beige book. It comes out a couple of weeks before. They get a blue book. It's a little bit closer, but folks, in the next 2 weeks, there's not going to be a whole lot that changes. So make sure you guys keep your eyes out for that. It's not a widely watched thing, but it comes out right at the end of the day. I think it comes out somewhere around 1 o'clock, or actually 2 o'clock Eastern. All right, so let's get on with the overall markets. I can remember to share my screen here, and we'll try and get on with that. All right. Bonds right here. We have the bonds moving a little bit higher. I've talked about this the last couple of days. We're seeing the bonds come off. And I tried to do this yesterday for you folks, but was not able to figure out how to use my pen here. So I've played around with it for a little while, and we are getting the hang of this. All right, so let's talk about what we were saying yesterday. As interest rates, so we're seeing interest rates go down here, right? So if we see interest rates go down, we can basically say that that is price going down. And if we think of it as a teeter-totter, that means that what's going up on the other side of it, interest rates, okay? And I've talked about this. I do not think that interest rates are going to start rising anytime soon. one of the aspects of allowing the interest rates to rise is the Fed stopping their asset purchases. So you'll hear that all the time. What do they mean by that? Asset purchases. What they mean by that is they're buying these bonds here. They're buying bonds and they're supporting that price. Okay, so if they push the price higher, what does that do? Well, it's the teeter-totter. If that price starts going higher, then the interest rates start going down. All right, so they're trying to suppress interest rates that way by doing the asset purchases. People have been talking about they're going to slow down asset purchases by the end of the year. Hey, this economic data that we're seeing as of recently, that's not happening, folks. As a matter of fact, I bet they're going to start talking about pushing back the possibility of interest rate increases. We've been seeing that. They're going to not probably slow down on the asset purchases because we need to keep these interest rates low until we start seeing the unemployment turnaround. And then with that said, I don't know, all right, it's being a little janky. I'm going to go to my pen. Let's go back to all right, there we go. All right, but Dow Jones Industrial Average actually looking a lot stronger earlier this morning after the open. We got some economic data here that was a little bit surprising here, especially the JOLTS job openings and the economic optimism. That's caused a little bit of a wet blanket on the overall markets here. As you can see, Dow Jones Industrial Average is off by another 120 points. Found support on this 50-day simple moving average as of this morning. Keep your eyes on that. Settlement below that is going to start signal to most folks out there that it is turning into a bearish cycle. Now, keep in mind, though, we are looking at this point of control here. Point of control is where the most time and volume has been spent. I talk about this time and time again. This acts like a bit of a magnet, and it's going to try and draw that back down to that point of control right here. And that's where we'll see it slow down a little bit. Hopefully, if we start breaking down probably below this Fibonacci, which is lining up with, let's call it 3,400, we settle below 3,400 or 34,000, I should say. 34,000 is going to be that line in the sand we're going to keep an eye on. We break below that, it's going to start looking a little bit more weak going forward. Seeing some weakness going forward, I should say. Let's see, can I change that if I... There we go. Let's see if I can do that. All right, here we go. Overnight, pretty weak. Coming into our economic data, there was some life in the markets, but you can see as soon as we got that economic data and the markets opened, the equities really started to slide. You can see that across the board in most of them. All right, so let's get on with a couple of trades that I've done. Nothing in Caesars, but I do have a couple of trades I want to talk about, and that is in Wynn. Not a great trade here, folks, but I tried to stay mechanical with it, and I dug myself a little bit out of this hole. If you guys remember, if you've been playing along for a while here, back here on the 7th of June. Yeah, June. I got to count my months. On the June 8th there, you can see I basically got long here on my Wynn trade. And with that said, that Wynn trade obviously didn't go along here with my strategy because I started playing this to the upside and I went in and bought the, I'm going to have to double check something real quick. Yes, it was on the 6-7 actually. I said 6-8. 6-7. I ended up selling those buying the September 135 calls in there for $8.35. Obviously, I was expecting a bit of a move to the upside, test those all-time highs. A lot of this had to do with the casino sector. I was seeing Caesars come out and talk about streamlining their process. They ended up having better than the best year ever on their profit. Now, that means, their overall revenues went way down because of the pandemic, but their profits were the best they've ever seen. So a lot of these casinos were probably following suit with that. So I played a lot of these casinos to the upside, despite the fact that they were not at full occupancy. I thought once that started catching on, folks would jump on that. Well, the market didn't accept that, obviously, and we can see this precipitous downslide here in my September 135 calls. Those premiums were going down. So I got mechanical with this and decided to, on the August 5th here, at this point in time, I was like, those long calls are just worthless anyway. I mean, they were maybe, a couple of pennies here or there, maybe a dime, a nickel or something. But at the end of the day, it wasn't really worth taking the entire trade off for zero. I might as well just leave it on there as a free bullish move. But I needed to stay mechanical. And with that said, breaking below 100 was the opportunity. And I was looking at selling on the August 5th here. August 5th, when we started getting down this low, got a confirmation there on the top, making that move to the upside, had high implied volatility. So that high implied volatility, what led me earlier on those 135 calls, you can see when we were buying those 135 calls on the 7th, I think it was 7th or 8th, you can see I had really low implied volatility here. So I was expecting volatility to expand. That's why I bought those 135 calls. Now with this sell-off happening, volatility really jacked up. So on the 5th of August, you can see I had that high implied volatility. Market had moved down. I was looking at like, this is great strike location to buy a stock. So I went in and sold the September 95 puts because I had that high implied volatility. I went into the SEP to take advantage of theta decay because theta decay is more aggressive the closer we get to expiration. And if I have high implied volatility, that volatility just comes out, then my premiums start going down as volatility comes out. All right. We know that's a product of volatility. As it increases, our premiums increase, even if the underlying doesn't move. All right. So with high implied volatility, bullish assumption, went in and sold those September 95 puts in there for $4.75. I bought them back. Bought them back this morning for 25 cents. All right. So right around there. Lowered the overall cost basis, covered half of my long call position from the premiums that I paid out for that. Still a loser in this trade, but staying mechanical, lowering overall basis on this trade and staying in the game. Now, I don't have enough time to completely make this trade a wash or a complete scratch by being mechanical with it, but I did cover my loss at least in half there by, getting a little bit more involved and staying mechanical with good probability trades. Take advantage of that volatility when it's at its highest. And even if I was directionally wrong in a situation like this, where we got this bit of a top here, I'll go back to the pin. So on these puts, we're getting involved with this volatility at extreme levels. So as that volatility comes out, our premiums in the options start coming out as well. So you can see that I was directionally wrong on selling those puts, right? I did get a final bounce there, but selling those puts and that volatility continues to come out. Yes, this trade was a bit of a loser. I was, running a debit, but I was worried. I wasn't worried about that as much as I was thinking, hey, I'm going to buy this stock at 95 for sure. And we've gotten this little bit of a bounce recently, and I've been able to cover those. Still long the calls though for almost nothing. But I'm not going to take those off because there's no reason to take it off if I can't get any real money for them. I think that they're trading around 40. Actually, they're trading right around 70 cents. 70 cents for my long calls in, that's in Dow, which we'll talk about. Let's just go on to Dow. The Wynn. Yeah, the Wynn, those Wynn 135 calls are trading for 7 cents. So let's take a look at the other one that I'm looking at here, and that is, let's just say if I do that. All right, let's take a look at Pfizer. Pfizer's been a trade that I've been involved in for a little while here. We did this as selling some September puts in here, and really pretty quick trade here on this because of the volatility coming out dramatically. I've only been involved in this trade for about a month. Got in here on the 19th. So we can see the volatility was extremely high here. That's why I'm trying to take advantage of premiums. When that volatility jacks up, those premiums get jacked up as well. And that allows you to follow my guidelines, which is, strike location. We're talking about deltas. Well, as volatility increases, we can get further away from where the underlying is and still collect that nice little premium. So I went into the September to take advantage of the high premiums and sold the 44 puts in there for 40 cents. Now you can see I got the directionality completely wrong in this case, right? I'm talking in this for a few days. The market comes down. I'm short puts. That means I'm willing to buy this underlying if it goes to that point. Now, I'll buy Pfizer if I had to, but ultimately I'm playing this as a trade on a bullish move with high implied volatility, selling puts, right? Well, the market came against me quite a bit. We're talking, $4, $5, $4 to $3 or $4, let's call it, against me. That's moving down into my face. I'm short these puts. But that volatility, look at this massive volatility crush going on. So we started out with some volatility up here. As that volatility comes out, we can see that we lost about 10 percentage points in volatility. That has made up for the bad directional move. Ouch, right? Most of the time, if you're playing a bullish move and it does something like that and jacks against you, you've lost money immediately. But because I followed the guidelines that I set out there, I share those with you folks. I want everybody clear a concept how we take advantage of these levers and pulleys, because we aren't always right on our directional moves, all right? So I got the directional move completely wrong, but the volatility coming out so quickly that made up for it. So literally getting involved in this at around $50 when I'm selling those puts, it's trading $46 now. That's against me. I was able to cover those for 7 cents this morning because the volatility, theta, all coming out of this trade, was able to get a nice premium out of that. Taking advantage of my incorrect directional assumption, but my correct implementation of these option strategies around our assumption, okay? Because our assumption is just that. It makes what is it? I'll let you guys figure that out. So if you figured anything out there, feed those bots. Come on, jam that like button. Throw those guys a cookie so they go out there and help somebody else find an option strategy or streamline their process. Like literally, this is how you should be trading. You shouldn't always be beholden to the directional moves of the markets. We can turn those probabilities in our favor. So if you want to learn more about that, subscribe also. That feeds those cookies. All right. If you have any other ideas, throw it over there in the comment section. I'll be happy to go over it before we're done here. All right. So let's go on to the last one was Dow Jones that I finally covered here in this trade. So Dow Jones, something to note here. We've been talking about this in the futures and in this ETF. Keep an eye on that 50-day simple moving average. It should signal some bearishness if we start getting below that. Yeah, it'll come back down maybe to the point of control, not a major correction. But if we blow through this point of control, it is a big downside move, probably pretty imminent. All right. So stay diligent. All right. Now let's talk about the DIA trade that we've had on I've had on forever. And was expecting some moves here to the upside. So playing this out on the 14th here is where I got involved in the call calendar. And I basically set this up according to my rules that I'm doing on spotting the trade. And the call calendar is a long-term bullish directional move. All right. And what we're doing is selling a shorter duration call to finance that long duration call that we're going to play out. So I used the September for my longer duration. This is, you can see way back in June. So yeah, playing this for a long duration upside move. Now with this, we want some high implied volatility, and we don't mind a move against us, meaning a downward move on a call calendar, because that allows us to shave off those short calls that we are using to finance it. So September, got long the 355 calls back in June and sold the 355 calls in June against that. Now my total debit was $5.46. I collected about $1.50 for those 355 calls I was short. Actually, you know what? So this isn't so confusing. Let's just start going into the pin. So getting involved in this trade on 5/14, I'm going to have to check my notes now. 5/14, I sold the call calendar. All right. Sold a call calendar in the Dow Jones Industrial Average. So I did the September. I sold the 355 calls. Hopefully folks can all see this. And bought the 355 calls, sold the 355 June calls to finance that. Now I did that as a total debit of $5.46. These were like $6.95 and $1.50 for these. All right. So when I got out of the June, I bought back these June 355 calls for a dime. All right. So I'm out of those, and I did that on 6/10. And so now I'm just long these 355 calls. I paid pretty steep debit for them, total of, I've increased my break even by buying this one back for a nickel. So it's really 5.56 there. Then I decided to go in again on 7/16 and sell, or 7/6. I went in and sold some 360 calls, and I did this in the August, selling the 360 calls for $1.06. That lowers my overall cost basis on this trade here by another $1.06. So $4.40, or actually 40. I'm just going to say 40. I forgot to add that 10 cents in. So now my total debit is that $4.40, right? And then covered those for about 24 cents because I rolled the August to the September. All right. And with that, I bought the 360 calls here in August and then sold the September 365 calls. So what am I doing here? I started out with the 355 calls, right? There was no real spread there. I'm long 355 calls in the longer duration, short the 355 calls in the nearer duration. Then I rolled that out and up to the 360s. So now I've created a spread, all right? Trying to lower my overall cost basis, but I'm created a spread, 355 to 360. And then I increased that spread even more and went to 360 to 365. So while I'm staying mechanical, yes, I am limiting some of my upside potential, but this trade is obviously not working out real great. So I need to stay mechanical and constantly be trying to lower overall cost basis on any trade out there. All right. And that's what I did specifically with this Dow Jones Industrial Average. So you guys, even though you still have a bullish assumption and don't want to mess with it, look at this. This was incrementally creeping higher. I did get this right. I mean, ultimately it is increasing, just not as much of a quick enough pace as I would have hoped for in this trade. But you can see that staying mechanical with this trade has allowed me to at least not feel the pain, all right? It doesn't always work out where we have that huge winning trade, but, I kept my hopes alive and lowered the overall cost basis to try and have this trade turned around, all right? So, Pfizer was a great trade on directional moves, making money. This one, directional move in my favor, staying mechanical with it, maybe not working out just because we didn't get that outpaced move. All right, that's about it. Nobody else has any more comments over there at the site. Where did you sell the 365 calls? Sold these 365 calls. It was basically on a roll. So the August, rolled the August to the SEP here. Let me just double check. So I rolled the August to the SEP. These August, I ended up paying 24 cents for. Here 24 cents, and then I sold these for $1.20. So my overall credit lowering of cost basis was about 96 cents. So that goes into here, taking out 96 cents. So now my break even is 344. Is that right? Somebody else can check my math on that. 344, lowered that overall cost basis on that. And then I ended up covering the September here today for a nickel. So I bought back the 365 calls for a nickel. That does increase my overall cost basis. I got to remember what I bought those back for, really. So I got to add 15 cents in there to be, 15 cents, 59. So that's really my overall debit on this trade, is that 359. So that's what I'm going to have lost on that. Does that make sense? Did I answer your question? Yeah, the 96 cents. Covered those for the 26, but overall, thank you for keeping me on task, Shao. And my trade on this, in the next couple of days, where do I need to have this be trading? I need, because I paid an overall debit of $3.59, those SEP 355 calls that I'm long, you add plus the 359, right, to this. And so I would need this to get up to 358.59 in the next couple of basically a week, 10 days or 9 days. So 358 does not look like I'm getting up there to that level. But you can see that I have lowered my overall cost basis on this trade quite a bit. So staying mechanical in it. Perfect. Appreciate it. All right. So if you guys learned anything at all, feed those bots. Smash that like button so it finds somebody else like you that it can help out. All right. Also, hit the subscribe. There's a little bell right next to it. Hit the bell so that you get notified when I come on unannounced. All right. And finally, comment over at the side. I'll search, or I'll circle back around, make sure you folks are all clear at concept. And I'll do it later on today and tomorrow. All right. So I'll circle back around for you folks. That's it. That's all I got for you. Other than, if you can't take that, take it easy.